Yeah, I mean, 3.5% fixed mortgage rate's pretty attractive in the grand scheme of things, and I think home buyers have been very sensitive to the moves in mortgage rates. So anything around 3.5%, I think, will get buyers out. You did point out an important point, though. While there's demand, there isn't a whole lot of supply. The amount of inventory out there for sale is at very low levels, near record low levels. And new housing construction is also improving, but still very low by any historical standard. So even if people want to buy homes, they may not be able to find it. So that's a governor on sales, a constraint on sales, despite the low mortgage rates.
Yeah, and certainly that supply shortage is something we've been following very closely. I wonder, though, with rates as low as they are, with commodity prices, for example, coming off as well, is this going to be enough to spur builders to create more supply, more houses?
I think they'd like to. The economics are right for them to build more, particularly at the lower price points, the mid-price points, workforce housing. I mean, there's too much supply at the high end, but a real severe shortage at the lower and middle price points. So the economics work. The problem they're having is the zoning, the permitting, getting construction workers because of the tight labor market. They just can't get all the pieces together to build those homes, at least not as fast as the demand is there for them. So I think they'll get it together, and we'll see more housing construction. But it's a slow build, so to speak, because of those constraints.
Mark, let me broaden out the conversation to the economy at large in the United States. Are you concerned at all that it is slowing and it's kind of hit sort of stall levels at 2%? Or is that just what we should expect?
Well, Tyler, 2% is the economy's potential rate of growth. So if we stay there, we're going to create enough jobs to maintain the current low unemployment, and life should be good, and expansion will continue on. But as you point out, if anything kind of goes off script and growth slows even a little bit, we get down into the 1.5% range on GDP, then unemployment will start to notch higher. And as soon as that happens, recession dynamics begin to take hold. And, of course, there's a lot of things out there, as we're seeing today, that could send things off script, that could derail things. So, yeah, I think recession risks they're lower than they were. End of last year, the threat of the president escalating the trade war was a real risk to recession. This year, that's off the table. But I think recession risks are still quite high, uncomfortably high, because we are traveling at a rate of growth that's just around potential, a little slower, and we'll have a problem.
So what's off script? Is coronavirus concerns off script? 737 MAX production halt off script? What would constitute a derailing of that 2% growth rate?
The 737 MAX doesn't help, but that's a one-time hit, and hopefully that comes back online sometime later in the year. And we understand that. We have a pretty good grip on it. I don't think that scares anyone too much. It's not great. It's a negative, but I don't think that's the thing. Coronavirus, that qualifies. I mean, because we can't handicap it. It's just very difficult to put a number on it. And you can construct some pretty dark scenarios. And, even though you attach a very low probability to those scenarios, that's a problem. And that's obviously what the stock market's discounting today. And adding to that nervousness is the fact that valuations in the equity market are very, very high. I mean, about as high as they've ever been, except for around Y2K and the dot-com bubble. Now, they should be high because rates are low, but they are stretched, and the market is discounting nothing but good news, and coronavirus is certainly not that. So, yeah, that would qualify, and we need to watch that very carefully.
As bond yields on the 10-year come down, Mark, how much attention do you as an economist pay to the so-called yield curve and whether it is inverted or positive?
I pay attention. There's good arguments why the yield curve may be overstating the case. I mean, historically, whenever the 10-year yield falls below the 3-month bill yield on a consistent basis, and it did that last year, you get a recession roughly a year later. It's pretty foolproof. That may not happen this go-around just because of idiosyncratic things that are going on, the global quantitative easing and the demographic demand for long-term bonds. So it probably overstates the case, but it's making a case. And the case is growth will remain slow right around that 2% level. And again, I think I haven't looked today, but I'm guessing you know this probably. The curve probably is inverted today.
It's a little bit negative right now, just by a little bit. So here's one cheer for an overstated case, I guess.